Hello and welcome back, guys. So in this particular session, what we will be discussing about is Jonjon. Okay, it's a question number 17 from SPR's exam kit. So what we've been given in the question is that Jonjon is a public limited company that prepares financial statements in accordance with IFRS. Jonjon has a number of bank loans which are repayable if it breaches its covenants. Okay, so has a number of bank loans which are repayable if it breaches its covenants. The covenants are based on profit before tax (PBT) and reported assets. A new accountant has recently started working at Jonjon and has discovered some issues relating to financial statements for the year ended 31st December 20x5, right? So intangible assets, anything to impairment, intangible assets, right? So SOFP includes intangible assets. Okay, so it could be brand, patent, anything. This asset has a portfolio of customers acquired from a similar business which had gone into liquidation 2 years ago. This asset is a portfolio of customers acquired from portfolio of customers, right? The accountant has asked the finance director why the asset has not been amortized in the current period. The finance director replied that he has changed the assessment of the useful life of this intangible asset from finite to indefinite. He suggests this on the grounds that it is impossible to foresee the length of the finite intangible asset's useful life due to a number of factors such as technological evolution and changing consumer behavior. Okay, so another issue is relating fair value, right? So what does it say about fair value? Jonjon owns investment properties that are measured using fair value model. Okay, and any gains or losses should be recorded in SOPL, right? In case of investment properties, IS40. And the accountant has discovered that the fair value is calculated as new build value less obsolescence. Accountant has discovered that the fair value is calculated as new build value less obsolescence. The valuations are conducted by the finance director. In order to determine the obsolescence, the director takes account of the age of the property and nature of its use. Sales values for similar properties in similar locations are available and are significantly less than the fair value estimated by the director. Okay, so they should use that level 1 information, which is already level 2 information, which is already available, right? So why are they using level 3 information? And that's a question. And then impairment test. Johnson has three main CGUs, cash generating units, which have goodwill attributed to them. The finance director has asked the accountant to perform an impairment test of the CGUs most using the most recent financial forecast as the basis for value in calculation. The realized cash flows for CGU were negative in 20x5 and far below forecasted cash flows for that period. The directors have significantly raised cash flow forecast for 2006 with a little justification. The projected cash flows has been calculated by adding back depreciation charges to the budgeted results for the period with an expected changes in working capital and capital expenditure not taken into account. Adding back depreciation to the budgeted changes in working capital and not taken into account. And that the future promotions and pay rises are dependent on this. Following this instruction, discuss accounting and ethical implications of above situations from the perspective of reporting accountant. Professional marks will be awarded in this question for application of ethical principles, right? So intangible assets. AS 38, intangible assets, states that an asset has an indefinite useful life only if there is no foreseeable limit to its useful life, right? Difficulties in accurately mining an intangible assets useful life. So in this case, what has happened? And gone to liquidity. Why the asset has been reply that Asian's assessment of useful life of the is justified on the grounds that it is impossible to foresee the length of. Okay, impossible to foresee, right? Just because it is difficult in determining does not mean that it should be indefinite. Determining an asset's useful life do not provide basis for regarding that useful life. Just because it is hard to determine does not mean that, or even if it's not accurate to determine, then does not mean that it can be classified as indefinite. Okay. So in case of Jonjon, customers relationship is with individual, so there is by definition time limit to that relationship, right? Because it's not indefinite like the person. If the person goes away or if the person dies right after a certain period of time, and if the relationship is doing well, still there is a time limit to that relationship, right? Failing to amortize. Why is it doing so? Because if it has to, if it amortizes it, it will reduce the PBT, right? So it will breach the covenant, so they have to pay the debt. Failing to amortize intangible assets will overstate profit before tax, thus covenant will not be breached. So in case of fair value, what have they done? What information did they use? Basically, level 2 was available, level 3 was the new that they used, right? Discover that the fair value is calculated as a new build value, less obsolescence, right? Valuations are conducted by finance director in order to determine the obsolescence, takes into account age, right, and nature of use. Similar locations are available and significantly less than those estimated by the director. IFRS IFRS 13 fair value measurement defines fair value as the transaction between or fair value of an asset as the price that would be received sell an asset Sell an asset, purchase an asset, or pay to transfer a liability, right? Asset or pay to transfer a liability. Liability in an orderly transaction between the market participants at the measurement date. Market participants, not any other date, but at the measurement date. Participants at the measurement date, right? It is a market based. So what are the different methods of determining it? Cost, and then after that we can use income, and then after that market based, right? So it's a market based measurement rather than entity specific measurement. Okay. In IFRS 13, a value measurement are categorized into three-level hierarchy based on the type of inputs. And they are as follows. First thing is level 1. Level 1 inputs are unadjusted. Quoted market price, okay? Quoted prices in active market for identical items to the asset being measured, right? And the second thing is level 2 inputs are adjusted prices, okay? Inputs are unquoted prices in less active market for similar items, not identical, similar items, okay? And level 3 input is unobservable inputs that are determined based upon management's So since level 2 input is already there, or whether it's a limit, what kind of thing is that, we need to determine that first of all as well, right? Similar locations are available, or similar properties, right? Similar. Due to the nature of the investment property, which is often unique and not traded on a regular basis, the subsequent lack of observable inputs data for similar identical asset. Fair value measurement are likely to be categorized as level 2 or level 3 valuations. Level 2 inputs are likely to be sales price, prices per square foot, for similar properties in the same location, observable market rents, and property yields from the latest transaction. Right, and then after that, level 3 inputs are based upon management's estimates, cash flow forecasts, using entity's own data, and assumptions about the future development of certain parameters such as rental income, that are not derived from the market, right? What else? Management should maximize the use of relevant, observable inputs and minimize the use of unobservable inputs. A valuation based on new build value, less obsolescence, does not reflect level 2 inputs to inputs which are available, such as what was that, similar price, right? Sales value of similar price. Of similar properties. As level 2 data is available, Jonjon should have used this when valuing the industrial property. Gains and losses on the revaluation of investment property should be recorded should be reported in SOPL, right? Therefore, overstating the fair value will overstate fair value of the property will overstate the profit and assets in the current period. Impairment test. So this is about IS-36, right? Impairment of assets. So CGU and then impairment test. So the realized cash flow of CGU were negative in the time. Significant cash flow, significantly raised cash flow to the with little justification has been calculated by adding back depreciation charges to the budgeted results for the period. Okay, so let's talk about that let's say, what does this state? Impairment of assets states that cash flow projections used in measuring so it will basically be impairment will be current assets will be greater than recoverable amount. Recoverable amount is lower of I mean higher of what is it value in use, and then the other thing is fair value minus cost to sell, right? So when we are measuring value in use, right, the cash flow projection used in measuring value in use shall be based upon reasonable assumption which represent management's best estimates of the range of economic condition which will exist over the remaining useful life of the asset. Right. IAS 36 also states that the management must assess the reasonableness of the assumptions by examining the past, by examining the causes of differences. Causes of difference is between past cash flow projection and actual cash flows. So we need to do a variance analysis, okay? How much is the variance? So the management should ensure that the assumptions on which its current cash flows, cash flow projections are based are consistent with past actual outcomes. So it does not mean that so just because the sale will be in the future and it is a new assumption does not mean that that should be incorporated. Okay, it should be a assumption based on which the cash flow was made from years ago and then it has been going on. So that should there should be consistency. Okay, that's what it means. So in this case, what has happened? And despite the negative cash flows, Despite the negative cash flows, despite the fact that the realized cash flows for 20x5 were negative and far below projected cash flows. The directors had significantly, not forget this word, isn't it over here as well? It's over here as well. Significantly raised forecasted cash flows for 20x6 without justification. So there should be a justification, right? There are serious doubt about Jonjon's ability to produce realistic and reliable forecasts, right? So according to IAS 36, estimates of future cash flows should include projections of cash inflows from the continuing use of asset. Second thing will be projections of cash outflows which are necessarily, it does not say about that, right? It says it does not take into account about the working capital and capital expenditure, right? Which are necessarily incurred to generate the cash inflows from continuing use of the assets, right? The asset and net cash flows to be received or paid for the disposal assets. So where do we use net of the cash? Is in investing activities, right? When we are disposing subsidiary, we use that net figure over there as well at the end of its useful life. IAS 36, it's that projected cash flows, cash outflows should include those required for the day-to-day servicing of the asset, which includes future cash flows, to maintain the level of economic benefits expected to arise from the assets in current condition, right? So there should be some allocations for that as well, for maintaining the economic benefits, or I mean like for maintaining in a day-to-day basis, so that the cash flows can be maintained, right? It is highly unlikely, so since they do not allocate, right, that no investments in working capital and capital expenditure, capital or operating assets would need to be made to maintain, highly unlikely, okay, to maintain the assets of the CGUs in their current condition. So some servicing should be done, right? It would seem that the cash flow projections that the finance director of Jonjon, the accountant to use, are not in compliance with IAS 36. These projections will most likely overstate the recoverable amount of the CGUs, thus reducing impairment loss. This would overstate profit for the period and the assets, state profit and the assets in the current period, both, right? So after this, ethics, right? So what are the ethical issues? Jonjon has breached several accounting standards. First of all, they had breached this IFRS 13, IFRS 13, IFRS 38, IS 38. All of these breaches overstate the profit, right? And assets. So maybe the director is trying to defraud the bank. So the intention is not good. See, all of these are indicating towards only one thing: overstate profit. All of the breaches. This is very important point, okay? I'll just bold it as well. This will make the performance and position of Jonjon appear stronger, and it's a public limited company as well, right? To the users of financial statement. In particular, Jonjon would not breach loan covenants. The users of financial statement, such as bank shareholders, such as banks, because they are the ones which will suffer the most, right over here. Shareholders, trust accountants, and rely on them to faithfully represent the effects of the company's transaction. IAS 1, presentation of financial statement, makes it clear that this will be obtained by or obtained when accounting standards are correctly applied, right? Nonetheless, 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 incentives might exist. Incentives might exist to depart apart from IFRS and IAS standards. So it is crucial to comply with ACCA's Code of Ethics. That's right. It may be a breach of accounting standard due to lack of knowledge, but this is not expected out of a qualified accountants. As per ACCA's Code of Ethics, accountants have responsibility to ensure that they are knowledge competent. However, the number of errors and the fact that they consistently overstate profits and assets suggests that the breach of standards is intentional. If so, the director of Jonjon lacks integrity and objectivity, right? So the self-interest threat to objectivity and integrity lies over here, right? It has been suggested that the accountant would suggest suffer right financially as well because they won't receive the dividend or whatever future promotions and pay rises. Suffer financially if the finance director those instructions are not followed, this is inappropriate. And inappropriate as it creates a risk that the accountants will price their interest above those of Jonjon's shareholders, right? Or you could say stakeholders. Only shareholders, everyone gets affected, right? The banks as well. The accountant should discuss the matters with the finance director, make him aware. Director make him aware of ethical duty, and keep a record of this conversation conversations. If the disagreement still exists, then professional advice should be advice from ACCA should be sought. Right? Accountants should approach the other non-executive, the company directors. So first of all, work executory as well, including non-executive directors. If the matter cannot be resolved, then the accountant should consider resignation. That will be the last. Okay, so this is how we basically answer this kind of question. So if you have any other questions, please do comment down below. I'll definitely answer it for you. Until next time, bye bye.